Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast. Hello, Vision Nation. I hope you're keeping well. In this week's episode, we're going to cover the incredible story of Bill Benter. We'll uncover how this guy made over $1 billion by betting on horse racing. We'll explore how Charlie Munger uses sports betting as a mental model to understand the stock market. And we'll also explore the importance of a circle of competence and investing in companies with a high return on equity, which are all key principles that Warren Buffett has used in his investing career. I'm so excited to start off with this fascinating story. This is a story about how this guy, Bill Benter, made a career out of gambling. And I'm not just talking about any type of career. This guy made over $1 billion by betting on horse racing. That's right, billion with a B. You might be thinking, what does this have to do with investing? Charlie Munger, who's an amazing investor that I've mentioned in quite a few episodes, well, Charlie's learned a lot about investing by studying sports betting. Charlie has a few speeches where he talks about using horse racing as a mental model for how the stock market works. With that, let's get back to our story about the unlikely horse betting billionaire, Bill Benter. So Bill was a really shy computer nerd type of guy. From a young age, he had a gift for math. But unlike these other nerdy calculus guys that are happy getting a PhD and teaching as university professors for their whole career, Bill wanted to use his math skills to get rich. Now there's different levels of rich. There's flying first class rich, and then there's having a hospital named after you type of rich. And Bill wanted the second one. Bill got his college degree in physics, and right away he went to play blackjack in Vegas. He used a card counting system to beat the casinos, and he did that as a full-time job. Blackjack is a really simple card game. A blackjack player with no strategy has about a 48% chance of beating the casino. When you play blackjack with basic strategy, the chances of beating the casino increase to around 49.5%. The casino will still beat a player with basic strategy. Now, the odds change with card counting. The probability of beating the casino improves to around 52%. And that's what Bill was doing. Isn't it crazy that Bill only had a 2% edge over the casino, but that was enough for him to make a full-time living doing this? It's fascinating. Bill had a lot of fun playing blackjack and extracting tons of cash from casinos. But of course, casinos started to notice that the skinny guy with glasses kept taking their money night after night. You can imagine the casinos were getting pretty fed up with this guy. Fast forward 7 years and all of the major casinos in Vegas give him a lifetime ban. He was winning way too much money off of them. After getting booted from the casinos, Bill went back to the drawing board. He needed to find a new project to master. He had a circle of competence in blackjack, but now it was time to get a circle of competence in a new arena. I love this guy's tenacity. He's like, oh, you're going to ban me? Okay, that's fine. I'm going to go find another way to beat you at your own game and make even more money. He thought about it a lot, and he ended up picking horse racing. The thing about horse racing is that the racetrack charges a sort of commission of about 17% on every bet placed. So it's not like blackjack where you only need a 2% advantage to win. Because of that huge transaction cost, to be successful at betting on horse races, you need a much bigger advantage than the 2% advantage you need in blackjack. So in horse racing, you need to be around 20% better at calculating winning odds in order to be profitable and win long term. Bill and his partner went to Hong Kong and gathered up the data for the past 10 years of horse races. They picked Asia because there's a huge horse racing culture out there, so there would be a lot of data available for Bill to use in his analysis. They put all this data into a computer, and you've got to remember that this was over 20 years ago, so it took them over 9 months just to get all the data into the computer. Bill's goal was to get a statistical model to figure out the actual probabilities that each horse would win. He got this model ready, and in his first year of betting, He ended up losing $150,000. He had a bunch of glitches because the data was not perfect. But that experience in his first year of betting gave him more data to work with to improve his models. Bill could see that he was improving with time, so he figured that the model would get better and better to the point where it did become profitable eventually. As Bill kept working away on his model, he started to win more often. His system was finally getting good enough to overcome the huge transaction fees that the racetrack was charging him. By the way, Hong Kong Jockey Club is one of the biggest horse racing tracks in Hong Kong. So one day, Bill gets a call from the Hong Kong Jockey Club, and at this point, Bill's probably thinking, oh no, this is just like Vegas all over again. They're gonna ban me. But instead, they actually said, hey, you're one of our best customers. What can we do to make your life better? And the reason they did that is because unlike the Vegas casino that loses money when someone is card counting, the Hong Kong Jockey Club racetrack earns money on each transaction. So even if Bill is making a ton of cash, the racetrack is earning their 17% off of every bet that he places. So the Jockey Club was happy to have him as a customer. Bill kept a really low profile and never appeared in the press. This was tricky to do because he also started making crazy money from his bets. I'm talking about tens and hundreds of millions of dollars a year. At this point, Bill had a whole team working for him. It was like a mini hedge fund that figured out mispriced bets in horse racing. All good things come to an end, and within a few years, the Hong Kong Jockey Club realized that here's this American using fancy computers, and he's making hundreds of millions of dollars from the local Hong Kong gamblers. The optics of the situation were not great, and the racetrack didn't want their local gamblers to feel like they were suckers. So for the second time in his career, Bill was politely asked to stop betting. I can imagine that was a hard decision for the racetrack. They were probably all sitting in a boardroom and someone goes, so this guy's paying us $20 million a year in fees and you want to ban him? Really? The whole story would make for a great movie. Bill is still alive today and he's given away tons of money to charity over the years. He's a stand-up guy. I love a story with a happy ending. So that's Bill's incredible story. Now let's go over some of the basic strategy that he used because it's a useful way of thinking about bets and investing. Here's a simple example of his strategy. Let's say there's two horses in a race. There's a really good horse that's favored to win. Let's call him Ace. And the slow horse that's predicted to come in last, let's call him Crayon. Ace is a favorite. If Bill places a $100 bet on him to win and Ace comes in first, Bill only wins $10. He's risking $100 to win $10. If you convert that to probabilities, the bookie is giving Ace about a 90% chance of winning. If Bill goes with the underdog and bets on Crayon, and Crayon comes in first, Bill's $100 bet will return $1,000. The probability for that type of payoff means that the bookies are giving Crayon about a 10% chance of winning. So what Bill did is he generated his own probabilities to figure out if the bookie was way off on the odds that they were offering. Bill would look at Crayon, and since he knows all about Crayon's history and how the horse was bred and which trainers the horse had and the horse's injury history and so on, Bill would do his own analysis and figure that maybe Crayon's chances of winning are actually 50%. So the bookie was only giving Crayon a 10% chance of winning, which means this is an amazing bet to make. Bill would bet on Crayon, and 50% of the time he would pocket a crisp $1,000 while only risking $100. Now, Bill found that these types of situations don't happen all the time, and he didn't want to make bets where he was given poor odds. He always wanted to bet where he saw a great deal. So the lesson here is you've got to be selective and only pick out opportunities where you have good odds. This is really similar to how Charlie Munger and Warren Buffett invest. Charlie is totally okay with not investing if he doesn't see a company that would be really close to a sure thing. Of course, there might be lots of companies that are great companies and they'll do well long term, but if Charlie overpays for them, that would be like making a bet on Ace when the bookie is giving him the correct odds. Charlie wants to have the odds in his favor because that's how he gets the biggest returns. So Charlie is willing to wait until there's a mispriced situation where the odds of winning are high. I've read and listened to a lot of Charlie Munger, and I genuinely think that he uses the mental model of horse racing as a way of thinking about the stock market. A mental model is just a fancy way of simplifying a complex system into a simple one. Of course, a stock market is a much more complex system than a horse racing track. But if you understand how a horse racing track works in terms of odds and betting, you can apply that thinking to the stock market. In horse racing, if there's a lot of money placed on one of the horses, the bookie will adjust the betting odds. So the way people bet can affect the betting odds. Well, the same thing happens in the stock market. If there's a whale investor who loves a stock and they keep buying more and more of it, that's going to cause the price of the stock to increase. That also means that investors that take longer to get into that same stock are going to be left off with worse returns because they're buying it at an initial higher price than this whale investor. Charlie talked about horse betting as a mental model in this speech called The Art of Stockpicking. It's a great speech. I'll include a PDF link to it in the show notes. In this speech, Charlie didn't just talk about horse racing, he also covered a few other topics that I think are really good lessons. I'm going to share them with you here. The first lesson is to pick a few investments where the odds are heavily in your favor and make sizable investments into each one of those. If you look at the investment strategy of the best buy and hold investors, they have this approach for looking for the undervalued investments. They sit patiently until they see a great opportunity, and then they back up the truck and make big investments. Guys like Warren Buffett, Charlie Munger, and Mohnish Pabrai have really concentrated portfolios. Mohnish has a bunch of interviews out there where he talks about concentrated portfolios, and investing mispriced opportunities don't happen all the time. They're pretty rare. And you only have so much mental power to do the research for each individual investment. For these top investors, that translates to fewer but bigger investments. This makes them more selective, and since each investment is a big chunk of their overall portfolio, they're going to make sure that it's as close to a sure thing as possible. An example of a Mohnish Pabrai portfolio might be to hold 10 stocks or less. Going back to the horse racing analogy, Charlie mentioned that in the 70s, IBM might be selling at 6 times book value, and a railroad might be selling at 1 times book value. By the way, book value is just the equity in a company. So you get the equity by taking the assets and subtracting the liabilities from the assets. The IBM and the railroad situation is just like the horse racing example. It was obvious in the 70s that IBM had much better business prospects than the railroad track. But once you take the price of the stock into account, are the odds giving you good value or not? In our example, Ace was the favorite horse to win, but betting on Crayon had the better potential payoff. And that's why you can't just pay any price for a stock. The price has to make sense relative to what the future looks like for the company. In your career, you're probably only going to find a few of these cinch investments. A cinch investment is an investment that's really close to being a sure thing. Charlie says that when you find these cinch investments, you need to load up. Warren Buffett has this idea of only investing 20 times in your whole lifetime. And I like that idea because you'd be a lot more careful about the investments that you make, and that would improve the outcomes of those investments. Charlie talks about how the top 10 investments account for most of the returns that Berkshire has had. So if you just look at that, it makes sense to focus your energy on having 10 really, really good investments instead of having 100 average investments. The circle of competence is another foundational concept that Charlie talks about. The circle of competence is the area where you're the expert. That's one explanation for why Charlie and Warren Buffett haven't invested in tech companies for a long time. It was outside of their circle of competence. You've got to play in a game where you have some natural ability. Otherwise, you're probably going to lose. In investing, that means investing within your circle of competence, investing in industries that you understand. For the horse racing gambler Bill Benter, his circle of competence was horse races. And something that really helped Bill's chances of winning was that the market for horse races was not efficient, so there were more opportunities to find good bets to make. If Bill went out and started betting on football games, he'd get crushed. That's outside of his circle of competence. It would take a lot of time for him to get the expertise needed before he'd start making money again. Investors that invest outside of their circle of competence usually get poor results. There's just too much stuff that they don't know, so a circle of competence is really important in investing. When you're an expert in an industry, that's when you're going to be able to see these mispriced opportunities. Bill Benter could see if the bookie is offering good odds on a horse, and Warren Buffett can tell if a railroad is selling at a good price because they're both experts in those fields. As a side note, it is truly amazing how well Charlie and Warren have done in investing despite not investing in tech companies. I mean, tech has done really well, especially if you look at the returns after the dot-com bubble. And so these guys haven't touched tech companies in a meaningful way until the Apple purchase. And they've compounded capital at over 20% per year since inception despite this. So Charlie and Warren have proven that you don't need to constantly be looking out for the next hottest trends, and that instead it's best to have a clearly defined niche where you're the expert. The types of businesses Charlie and Warren bought were not exactly sexy, but they compounded capital at an incredible rate, and when you do that over a long time period, the results are amazing. That leads me to another great lesson from Charlie, which is the importance of buying into great businesses. Charlie says that about $200 to $300 million for Berkshire came from buying low-quality businesses that were really underpriced. But the vast majority of the Berkshire Hathaway wealth came from buying great businesses and holding them for a long time. Over the long term, it's hard for a stock to earn a much better return than the business earns. If the business earns a 6% return on capital over 40 years, and you hold that business or that stock for 40 years, you're probably going to make about 6% return, even if you originally buy it at a huge discount. On the other side of the equation, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive-looking price, you'll end up with pretty good results. Businesses earning a higher return on capital or a higher return on equity are generally higher quality businesses. If they maintain high returns on equity for many years, it probably means that they have some sort of moat that is protecting them from competitors. In last week's episode, we talked about 100-baggers, which are investments that give you a $100 gain for every dollar that you invest. Well, if we take Charlie's example of a business earning 18% return on equity, and if that business can do this for 30 years, assuming that you don't overpay for the stock at the beginning, and assuming that long-term the stock will grow in value at the return of equity, so at 18% per year, that would mean that a $10,000 investment would give you over $1.4 million in 30 years. Mind-boggling numbers, but the math checks out. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, and if you know someone who's interested in investing, please share this episode with them. Thanks so much for listening, and I hope you have a great day.